Well, thank you very much for the kind invitation, and thanks for inviting me this morning. And I should also say congratulations to the Bond Investors Congress on reaching 20 years of age. I think you can safely say that in those 20 years you've had about as wide a range of market conditions as you could either hope for or wish for or want. And who knows, as you say, what comes next. I think if my memory serves me correctly, you've had quite a few speakers from the Bank of England over those 20 years, and we're always happy to be here. It is, of course, a period, as Christopher was saying, of big change at the Bank of England. We're under a month away now from the formal launch of the new regulatory system in the United Kingdom. And the Bank of England's role, as you'll probably know, is going to be substantially expanded in that new system in the United Kingdom. And we've been busy preparing for that launch for what seems, I have to say, like a very long time now. Actually, it's getting on for 3 years, so it actually is a very long time. And that's how long it's taken to prepare the legislation, put it through Parliament, and get all the arrangements in place. And the PRA, which I will be Chief Executive of, for Prudential, the Prudential regulator of banks, insurance companies, and major investment firms, we've actually now moved into our new home at 20 Moorgate, and we're raring to go. So that's all good for us. And the larger Bank of England will, in the future, have an even greater demand for the tremendously useful market intelligence and information and views that you all give us, and for which we are very grateful. We are very grateful for this information. It gives us a huge amount of intelligence, and we do put it to very good use, I can assure you of that. I wanted to spend my time this morning setting out a few of the big issues that we face today, which are at the heart of thinking about the future of prudential regulation. We were discussing beforehand, well, you know, where do you start and where do you end in terms of big issues that we face? But I'm going to pick out a few and concentrate on those. And the first issue I want to start with, I'll start with an observation about the financial crisis, which is that in the last 12 months or so, I think the crisis has moved on to another phase, sadly, you may say. The first phase of the crisis was very much, in many ways, a prudential phase in nature. It was, of course, wrenching at its height, and it lasted well beyond, if you like, the sort of the peak period of late 2008, early 2009, not least because of the problems in continental Europe. But the last year or so has seen a very, in many ways, very distinctive phase of the crisis emerge, characterized by problems originating in the conduct of business, both domestic and international. Some of those problems are in the activities of financial markets, but some of them are also in, you know, much more sort of, if you like, closer to home in the high street domestic banking. So the origins of these problems are actually quite diverse. LIBOR is obviously, in a sense, the foremost example of the problem in markets. But in the last year, we have faced, obviously, a continuing, in a sense, build-up of domestic issues around payment protection insurance, interest rates, hedging products, and also a set of issues coming much more internationally in terms of money laundering, sanctions, and so on. And if you put all of those together, it is a big issue. And it's posing this sort of second phase of the crisis, the conduct phase of the crisis, a number of, I think, very big questions. I think probably the first and probably the biggest question is that major banks and major financial institutions have to assure themselves that they can operate their institutions within a sort of a framework of rules, and I'm going to come on and talk about frameworks of rules a bit more in a moment, which will require higher standards of compliance than were the case in the past. Put very simply, society expects firms to conduct themselves to standards which, unfortunately, we now understand were not present, say, 5 to 10 years ago. And this change of expectations is a fact, and one that all firms will have to meet and live up to, and all firms will have to actually assess that they can live up to it. It's also true that the second leg of the crisis, this conduct leg of the crisis, if you like, will shape the thinking of governments about structural solutions. The initial work on structural measures, such as ring fencing, was a response to the prudential leg of the crisis. If you think about the Independent Commission on Banking report in this country, chaired by Sir John Vickers, it was very much a response to the prudential leg of the crisis, and rightly so. But the work that is going on in Parliament at the moment, in the UK Parliament at the moment, and in other countries, is taking, if you like, that sort of response to the prudential crisis and looking at it through the lens of the conduct crisis we have seen. And there's every reason, of course, to expect that to happen. But it's important to understand that that is, if you like, the legacy and the impact of what I regard as the second leg of the financial crisis. So that's the first issue I would highlight. Let me move on now to the second large issue, which I call the issue of judgment versus rules. Now, this is, again, very relevant to what we're doing as we put what I might call the final touches to the new approach to regulation that we're adopting. And there is, in my view, a very sharp tension today between systems which rely on what I would call the application of judgment against a framework of rules and systems that want to put more and more rules in place. And I'm going to say a little bit in a moment about the most obvious and sort of most talked about manifestation of that at the moment, remuneration. But let me put it in context just to start with. There is no doubt that if you analyse, as has been done exhaustively, the sort of the causes of the crisis, there were failures of judgment. That's beyond doubt. But there were also, in my view, failures of rules. So it is not a one-sided story. And there is no doubt that the consequence of those, if you like, causes of the crisis has been pressure for more rules, actually more rules, and pressure to do more. You know, when we run into a problem, there is a pressure to do more of that. And this brings out the tension. Now, in the approach we're adopting in the Prudential Regulation Authority, we are very clear that we have to exercise judgment, but we have to do it against a framework of rules. We have to do it against a framework of rules, not only because, obviously, it's a basic point about the rule of law, but because all of you and other people in financial markets and institutions obviously have to expect us to behave predictably. We understand that. But we also understand that, frankly, we have to apply judgment sensibly, because if, in my view, we have a rules-only system, then it encourages a large amount of activity which says, how can I get around this rule? And I don't think I've ever quoted Winston Churchill before in a speech, but I'm going to do it this morning. I think one of his quotes is that if you have 10,000 regulations, you destroy respect for the rule of law. And I'd emphasize there the word respect. It's not about destroying the rule of law. It's about not having a system where there is a basic respect for the judgments and what we are all trying to achieve. And I want to illustrate that in the context of the issue of bankers' remuneration. The issue that has come to light, in a sense, the surface, is about whether we have a system which has, as we do today, a code where we can apply judgment around that code. But if you like, the rules of the game are quite clear, but there is a code and we apply judgment around it. And I've observed over the last 2 years in applying this code that we have moved a long way. We have moved a long way, for instance, in terms of banks reducing their variable remuneration pools where they have suffered losses for past events, where they have suffered fines, redress for past conduct events, for instance. It is now accepted that that has to be taken into account when setting the pool. And we have also moved a long way in institutions and individuals accepting that where that they are liable and there is unvested deferred remuneration, and by the way, we believe in more deferment of remuneration because, if, to use a slightly the vernacular, it creates skin in the game for a long time, that there is a withdrawal of that deferred remuneration. And I can tell you that 2 years ago, and it's apposite at this time of year because this is the remuneration season, as you probably know, there was quite a lot of fighting over these principles. We spend a lot of time really, telling institutions quite often, quite firmly, this is what you got to do. This year, we haven't had to do that. It is part of the understanding of the judgments and the rules of the game that are applied. And I frankly think that's a good thing. And what worries me about what is being proposed is not about what level of pay people should get. That is not my concern. What worries me is that if we move to a system of tight, of supposedly tight rules, we will lose this, sensible judgment, and we will lose the ability to actually apply redress for and clawback for past misdeeds that come to light in an attempt to find very tight rules which constrain remuneration. And so it is a good illustration for me of this tension that we have between judgment and rules. And I grew up in the Bank of England working for a long time for Eddie George, who I think also spoke at this conference in his early days, because I remember writing a speech. And he always used to say, in the end, you've got to do the right thing, and you've got to get institutions and people to do the right thing. And that is part of our principle of applying judgment. So the thing that concerns me most about this tension between rules and judgment is the idea that a very tight system with many rules will encourage people to do the right thing. I'm not convinced it will. The third issue that I want to highlight is another of the very big debates that goes on at the moment. And as many of you will know, there are different views within the building of the Bank of England on this subject. And that is the question of whether we should have a risk-based approach to prudential regulation, or one that adopts rather more simple tools which do not explicitly try to, in a sense, model firms' risk. I'm very clear on this for my own part, that I think that we need, as supervisors, always to look at any problem from a number of angles. I therefore like to have a number of tools of analysis, but I would not put, if you like, a simple non-risk-based tool at the front of my sort of armory of toolkit. So I'm not a sort of put the leverage ratio in the front line person, I'd have it in the back. And I'm also of the view that there is a role for a risk-based system, not least because as supervisors, we need to know how you as participants and as firms manage your risk. That's very clear for me. Now, what we also have to recognize, and it's very clear to me when I talk to investors, that there has been a substantial erosion of the credibility and confidence in the system of risk weighting. That's because it's overly complex, it's opaque, and people think it's gamed. And so I think that whatever the outcome of the debate, but I hope it is to preserve a system that is based on rules with simple tests in the background to act as sense checks, that we are going to have to take steps to buttress that system. We are very clear on that in the regulator, and I think one of the key steps that we and the firms have to take is to increase what I call the meaningful transparency of the system of prudential risk-based regulation. And that's a job for us, and it's a job for firms. And one of the most encouraging things for me last year was the conclusions of the Enhanced Disclosure Task Force, which was a combination of both firms and investors, and had the sort of the overall sponsorship of the Financial Stability Board, chaired by Mark Carney, who came out with a set of recommendations which essentially said, look, there's a lot of data dumping goes on. What we also need, or what we really need actually, is what I might call sort of meaningful transparency. Transparency which allows people to more easily map between the face of an accounting balance sheet and a risk-weighted balance sheet. Transparency which allows a better understanding of what, for instance, Pillar 2 regulatory capital is composed of. And I was pleased to see yesterday, I don't, as a rule, choose to publicly praise or criticize the firms that I supervise, but I will break that rule, that HSBC in their publication yesterday did adopt much of the recommendations of the Enhanced Disclosure Task Force, and they are committed to doing the rest as soon as they can. HSBC, I should say, were one of the, in a sense, one of the sort of the leading lights behind the report, so it's not surprising. But I'm very encouraged by this, and I would encourage other institutions, please, to follow suit, because I think this done sensibly, will be a step forward. Two more issues that I want to touch on before I finish. The first one for us is a very big one. Again, these are all very big issues of how, as supervisors and as an industry, we balance the objectives of safety and soundness, which is our objective as a regulator, and the wider agenda for growth and competition in the financial sector, and obviously for lending. This is a very big issue. Our objectives as the PRA are safety and soundness, and subject to that, this is the language of the Monetary Policy Committee you may be familiar with, the FPC's objectives, I should say, are safety and soundness of the financial system, and subject to that, to support the policies of the government towards growth and competition. Now, I'm a member of the FPC. I fully support that. It translates, as I was going to say, into the approach of the Prudential Regulation Authority. The question is, what more do we do? I'm not going to spend my time dwelling on all the many things that could be done by a central bank, but I would pick up one or 2 points. The points I would really pick up is that I think that when you unpick the lending data, there are 1 or 2 areas where there are particular problems, or particular issues, I should say. And the interesting thing for me is, having been around rather more years than I should have been, is that there's nothing new about these areas. In many ways, they were the same issues that we were wrestling with in the wake of the recession in the early 90s, which are small firm lending and high mortgage loan-to-value lending. There is, in my view, a need to go back to some of the approaches that we used in the 90s with small firm lending to try and get a better understanding of what actually lies under the surface of this issue, rather than, in a sense, agree targets and then be concerned about why we don't hit them. And I think that is a measure that all of us in the authorities need to give more attention to. So let me wrap up with my final issue, which again is a very big one. You never get a speech from anybody in my position without me saying that one of the most important, if not the most important things we have to do is to solve the too big to fail public money problem for large banks. And indeed we do. I think we've made a lot of progress over the last few years in terms of getting resolution plans with real traction behind the resolution planning process. Bail-in is very much an idea that is now on the table. I have to say that I'm a strong supporter of it. And we have to take that work forward. And why do we have to take that work forward? Well, there are 2 reasons. One is because as long as we have the too big to fail problem, then inevitably in the wake of the crisis, we will have a system that is going to have more intervention from government than an industry should wish. But of course, there are very good reasons for that. There are very good reasons for that if it's an industry that is dependent on, in some sense, on backstop government support. But secondly, what we're observing is what I call the balkanization of the banking system, that as long as we have a system where we cannot resolve large banks with cross-border operations, and as long as there is uncertainty about that, then the trend towards balkanization, which essentially means subsidiarization and trapping of pools of capital and liquidity, and the very big question mark as to then whether we have a world financial system that is less efficient than it ought to be, will not go off the table. That's quite simple. Now, I think that the answer is that we will end up with a system for retail finance, which is more nationally subsidiarized, and the reason for that is the greater clarity that I think national authorities have to give to consumers. But I would hope, my own view is that we do not end up with that system in the wholesale markets, because if we do, then it will be less efficient than it ought to be, and that frankly we all need it to be, and frankly that you need it to be. This is a very big issue. I mean, they're all very big issues that I've highlighted, but I would highlight this one as very big. We are committed to working on this until we solve it, but I don't underestimate the complexity of it. Thank you.